Hello again and welcome to my channel. So during this night, we're going to talk about cash management. Let me inform you that this is already the fourth video related to working capital management. So I have already discussed the working capital management in general. I've also talked about inventory management. I've also talked about receivable management. Okay, now if you are already masters of those videos, of those lectures, then proceed to cash management. But if you wanted to learn more about those three topics, I guess, yeah, three topics, then you can go immediately to the end of this video. So there are suggested videos that will appear. So they are thumbnails of the past episodes that I have taped. So you can click on it and then you can watch the first you should watch the general working capital management first. Okay? Now, pardon me if my English is a little bit rusty because it's not my primary language. So if you feel like I'm talking slow or if you feel like my pronunciation is wrong and you cannot understand it, it might help if you go to the settings of your YouTube application and then click there times 1.25 times 1.5 times 0.175 or two times uh, depending on you on what you want. And of course, you can click on the closed captions for subtitles so that you can understand if ever. Okay? Now, let's go to the topic at hand. So we have cash management. So this particular topic, we're going to answer, in this particular video, we're going to answer an estimated of 5 questions. Okay? 5 questions, estimated only because I haven't counted it before I tape this. So 5 questions so that we will master this cash management. But before we do that, I have here one question. If you are the financial manager of your company, so that is our point of view. Okay, in this topic, we are the financial manager. If you are the financial manager of your company, how much cash will you leave in the company's bank accounts or funds? Like it could be revolving fund or it could be petty cash, something like that. That is the first question. Of course, I'll give you some choices. First is zero. You should not have any cash balance. This is good for people who really invests their money. So if they have some kind of a bigger money, like for example, 1 million, they do not let that 1 million rot in the bank. They are going to invest it in order to return. So that might be the reasoning why should we have the zero. As large as possible. That's the second choice. And we have smallest, small amounts. So, of course, the correct answer will be it's not as large as possible. Because as I have mentioned, if you're going to keep your cash, you are foregoing a lot of opportunities for investment. If you're going to keep that cash, it will not grow. It will not gain any returns. Okay? So, it will not be as large as possible. You understand? Now, especially if you are already a big company and you have already lots of funds, that is more than your operational needs and more than because you have also funds already when it comes to uh, low economic uh, low economic condition of the country. You have already some reserves. Let's call that reserves. You have already reserves. Your money is a little bit higher already than the needs of the operations. Of course, you have to invest it in order to earn returns. Okay? So again, it's not this. It's not as large as possible. Okay? Now, it couldn't be small amounts because actually, in general answer, you have to keep cash for usual transactions that you have to pay for cash. Okay? So it's not small amounts also, and it will never be zero because you need cash. And I will elaborate that later on. Okay? So, since we have established that, let's answer the first question. What is the first question? The first question is, why not zero? So, as I have said, you cannot make your cash balance zero. The question is why. So, there are three reasons. If you have to take note of these reasons. The cash balance can never be zero because of, first, transactional motive. Believe it or not, there are some transactions that you have to pay for cash immediately. You cannot pay for cash immediately. You can pay for checks because that is cash in this particular lesson. The check and the cash, it's the same for us. Okay? Now, we cannot, of course, we cannot say that we don't need any cash because again, there are some transactions that needs payment of cash. So that's the answers. The first answer for why will we not reduce the cash balance to zero? Why not zero? Because of transactional motive. You get me? Now, we have also precautionary motive. For emergencies. Now, what happens if ever there is an emergency and you don't have cash? So, even if we are not talking about a certain company or companies, in our personal lives, what will happen if there is an emergency and you don't have cash? Of course, you will find it stressing because you have to find that cash. Sometimes you sell the things that you love for smaller amounts just because you have to have cash because there is an emergency. So we need to prevent that. Okay? That is why you have to keep cash and it will not be zero because of this motive, precautionary motive. And the third one is the speculative motive. Speculative motive. Like for example, there are items that your company needs or there are items that you need, right? And then you cannot buy it because of large costs or it is very expensive. Normally, it is expensive. Now, there is a bargain that has happened. Maybe because there might be some companies who experience emergencies and they don't have cash, so they are selling that particular item for lower costs. Okay? Now, if you don't have any cash, you cannot pay for that. You cannot have that. Right? So, speculative motive is as if there is an opportunity that happens like bargains and etc. It is very good to keep cash in order to avail those bargains, in order to uh, in order to get those opportunities, enjoy those opportunities. Do you get me? So that's speculative motive. So again, why can't we make our cash balance zero in our company? It is because of transactional motive, precautionary motive, and speculative motive. Transactional motive, there are transactions that you need to pay for in cash. And precautionary motive, for emergency purposes, sometimes you need cash. And of course, for bargains and other opportunistic transactions, in order to enjoy those opportunities, you have to have cash. And that is what we call a speculative motive. So that's question number one. Next question. Question number two. Um, Question number two is, let me erase. How much cash will you keep? So that's the second question. How much cash will you keep? And then, as I've said, how much cash are you going to get from your investments every time that you have to convert cash from your investments? Because as I've said, the basic or the foundation is that if you have cash, you invest it. Okay? So that it will earn returns. So of course, we cannot discount that there is an annual demand of cash in the company, right? For example, so again, the two questions. Let's go back to the two questions first. First question, how much is the optimum cash balance? And of course, the second one, how much cash are you going to get from your investments every time that you need some cash? Okay? You get me? So those are the two questions that we have to answer. Question one is why not zero, right? So again, number two, what is the optimal cash balance? And number three, how much cash will you get from investments to satisfy your cash needs? Okay? So, basically, as what I'm telling you, let's have an illustrative problem, for example, so that I can express it in simple terms. Illustrative problem. So, Baby G Company. So, I'm always using Baby G because that is my claimed nickname. Okay, so nobody tells me that I'm Baby G, but it's my choice to introduce myself as Baby G. So you can call me Baby G. Okay, so Baby G Company has annual cash requirements of let's say 5 million. Okay, 5 million in a year. Now, before I go to the other given in the illustrative problem, let me tell you guys, if BBG needs annual cash of 5 million, will it keep 5 million immediately in January 1, which is the first day of the year? Of course not. Do you understand? So this 5 million will be stored first in the investments. So it will go to the investment so that it will earn. And later on, from that investments, you have to convert it into cash again. But bit by bit. Like for example, 500,000 per conversion. So do not, if the annual cash requirement, it is unwise if ever you're going to get immediately the whole 5 million in the first day of the year. You get me? So, it will be in the investments. And then, as you need it, you are going to convert the investments bit by bit in order to satisfy your cash needs. So, that is what is meant by this number 3. And I needed that illustration so that you will understand what is the meaning of this number 3. Okay? Now, before again we go to the other given, how was this computed? That was computed based on your cash budget. So your cash budget, if you are already well versed with budgeting, it's just like this. What are your cash expenses per month? And what are your capital expenditures like machinery and etc.? Because of course, a company that is good or a company that has a good management team will budget before the year happens. So that's what will happen. So you budget for your cash expenses, you budget for your capital expenditures like January, February, March. And after you have budgeted for everything, then you have already the annual cash requirement. Okay? So again, how will you know about the annual cash requirement? You do cash budgeting. Okay? So you have to list your expenses, you have to list your expenditure, including the capital expenditures, including the taxes and everything, the salaries, so that you'll be able to compute the annual cash requirement. Okay? Now, let's move forward. Let's have the other given. The other given is that, this is just an example, that is not really 500,000 because we have to compute it first. So, the 5 million annual cash requirement earns, or the investment earns, 10%. So, this is what do we call as opportunity cost. It is because if you're going to get that 5 million without investing it because you need annual cash requirement of 5 million, this is the percentage of income that you are foregoing. So that is opportunity cost. Okay? Or, in other authors, that's carrying cost. Familiar, right? The carrying cost is very much used in the inventory management. So, here in the cash management, the opportunity cost is equivalent to carrying cost. Which means, if you keep too much cash, this is the carrying cost. Do you follow? The burden. Do you follow? The burden is you will forego some opportunity income. Do you get me? So that's 10%. That's one of the given. And aside from which, we have conversion cost. Or in the inventory, we have cost to order. In this case, you have to order cash from the investments. So, the right term in the cash management is conversion cost, because if you are going to transform these investments into cash, you will tend to incur cost. Okay? Because for example, these investments, in order to turn into cash, you have to transfer it to another person, and that other person will give cash. So that's selling, di ba? Selling of investments. So if that is selling of the investments, you will have to pay for something. Okay? So that is what do we call as conversion cost. It is the cost of converting your investment to cash. Like selling your marketable securities and selling your other investments, selling your bonds, something like that. Do you get me? So, the conversion cost, for example, is 40 per conversion. So, those are the given that is needed in order to answer this number 2 and number 3 question. Okay? So, what do you do? It's as if you are computing for EOQ, which is why I always compare the opportunity cost with the carrying cost and then the conversion cost to order. Because the formula in getting the optimal cash that you are going to convert from the investments to the company is similar to EOQ. However, that is what do we call here in cash management as Baumol model. Baumol model is just optimal size of cash equals square root. So, Bisaya. Square root. So, I will remove the accent. Okay, so we have 2 times your annual demand still. The same with the inventories. Although this is annual requirement for cash. Times, of course, the conversion cost instead of cost to order. And then you have to divide it with the cost to carry or opportunity cost. That's how you get the optimal size of cash that you will convert every time you need cash for the company. Okay? So, let's compute. First, let's substitute. 2 times 5 million times 40, which is the conversion cost, divided by 0.10 and then square root. And we will get, let me calculate it. So 2 times 5 million, it's 10 million, right? Times 40, divided by 0.10. So it's very big. That's 4 and 9 zeros. So square root of 4 with 9 zeros. And you get 63,245. 63,245. Okay? In order that you will have a minimum opportunity cost and conversion cost. So you have to convert every time 62,285.55 from the investments to your company. So as to how many times will it happen? Of course, 5 million is your cash needs divided by 62,285.55, and you have 80 times. So 80 times. So in order to reach 5 million, you have to get 62,285.55 from investments 80 times. Okay? Now, if the company is operating 360 days, okay, and you are going to get 62,285 from the investments for 80 times, 360 divided by 80 times, that means every 4.5 days, you're going to sell your investments. You're going to convert it into cash in order to meet the annual requirement. So that is the meaning of that. Okay? So there are a lot of questions that could be answered because of the Baumol model. Like for example, how many times does it need, how many times conversion happens? 80 times, right? So you have to convert from investments to cash 80 times. Because according to Baumol model, you can only get from the investment 62,285.55 in order to minimize the conversion cost and the opportunity cost. Okay? So, the question could also be, how many days per conversion? The answer is 4.5 days. Okay? But since I have established here the question 2 and question 3, so what is the optimal cash balance? So, the optimal cash balance is actually how much is the optimal size that you have computed using Baumol model. The answer is 62,285.55. Okay? But that is not the cash balance. The optimal size of conversion from investments to cash. That's the optimal size. That is what is meant by this 62,285.55. But the question is, how much is the cash balance? So the average cash balance that you should keep in your company is divided by 2. The average cash. Which is basically the same with the average inventory. If you can recall our inventory management topic under EOQ. So, 62,285.55 divided by 2, and you will get 31,142.775. That is, if you are confident with your budgeting with the annual cash requirement, and you are confident that the conversion cost will stay 40 pesos, and you are confident that the opportunity cost is 10%. Okay? But sometimes, the cash balance of some companies, they're not going to stick to this. They're going to go much higher because, again, there might be emergencies. There might be transactional needs, transactional needs of cash. Okay, and we have some some opportunities that we cannot foresee for speculative motive. Okay? So, it's much higher than this one. So, we have answered already this, and a lot of questions can be answered by the Baumol model. Now, number 3, how much cash will you get from investments to satisfy your cash needs? Answer, 62,285.55 80 times every 4.5 days. But the answer to that question is only this one. Okay? So that's question 2 and 3. What's the next question? The next question is, how fast? How fast do you want your collections to arrive in your bank account? And how slow should your payments to creditors? How slow should your payments to creditors be? So of course, the answer for that one is you wanted your collections to be as fast as possible, right? So also, on your payments to creditors, you wanted it to be as low as possible. However, you have to take into account that your image will not be destroyed because you are late in paying. So meaning, you don't compromise your image. Although this is your principle, how slow should your payments to creditors be? Your answer is as low as possible. However, you have to maintain your credit image. Okay? So, that's the answer. But actually, my point of asking these questions is that what are the techniques in order to make your cash collections faster than ever and make your payments as low as possible? Okay? So, let's talk about that. So, first, since you have already understood this, you have to analyze the floats. The floats is the delay. Okay? So, the simple term for floats is delay. So, when you want your cash to be as fast as possible, that means you minimize the float. Minimize the float. Okay? And if you want your payments to be slow, maximize the float. That's the meaning of that, maximize the float. Now, let's talk about the techniques. How do you minimize the float in cash collections? So, let's talk about floats first. So, when it comes to cash collections, we have what we call as mailing float. Mailing float. Whereby, it is assumed here that your customers are paying in checks. So, they are going to write the check. And after writing the check, they're going to mail it to your company. So that is what we call as mailing float. Like for example, it takes 1 day for the payment of the customers in check to arrive at your company's premises. That's 1 day. Mailing float. Okay? Now, from your company to the bank, that is what we call as processing float. From your company to bank. Okay? So from your company to bank. That's the processing flow. Like for example, that is also 2 days. Now, here's the last. We have the clearing float. It's the bank clearing process. Because of course, the bank should be able to check the check, check the check, check the check from your customers if they are not bouncing checks, okay? Or if they are not overdraft, or if they are not fake, something like that. Do you get me? So that's clearing float. For example, the clearing is 3 days. So meaning guys, you will be losing money for 6 days. Because supposedly, it has already earned. If ever the float is not there, like the float is zero, your daily um, collections from your customers, like for example, if it is 1 million per day, you have lost a lot already. Because that 1 million times the 6 days supposedly, that's 6 million, should have earned interest for the year, like for example, 10%. Imagine, you lost 600,000 because of that float. Do you get me? So if your collection is 1 million per day, times the delay because of the float. So the 6 million is the delayed collection. Although the collection is from the point of view of the company, is from the customer to you, actually in here in the cash management, it's from the customer to your bank account. If it is in you, in your company's premises, it's not yet considered an investment. It's not yet good. Okay? So it should be from the customer to the bank. 6 days. That's what will you lose in a year. Imagine. So let's talk about the techniques, guys, on how to minimize this opportunity cost when it comes to cash collections. We have lockbox system. What is this lockbox system? Lockbox system is when the customers will pay not to the company already in order to eliminate this mailing float. Instead, the lockbox system, the bank of our company, for example, offers this service to us. Our bank will place strategic boxes like post office, something like that. Strategic plate. Do you get what I mean? So meaning our bank is putting some boxes, for example, in different places, and that the customers will go directly to pay on those lock boxes. And if they are going to pay, then the mailing float will be eliminated that one day. It's because from here, our bank will collect it in a specific period of time. Like for example, every 3 p.m. of the afternoon. So of course, there will not the mailing float will be eliminated. Um, the mailing float will be eliminated and the total float will be decreased. So we have lockbox system. Or you have to decentralize your collection. Okay? So how do you decentralize collection? Of course, you make collection centers. So the company will have a lot of collection centers. The customers will not will not already mail their check payments to your company. It will go directly to the collection agents, and the collection agents are going to deposit it much faster in the banks. So it will reduce also the floats. Okay? Now, next, we have electronic payment. Like for example, the customers will pay using GCash. Okay? GCash to your bank account. Of course, the float will be diminished or minimized if that will be the case. Because GCash payments, uh, as if it's almost automatic, that will be credited to your bank account. You get me? Now, Here's the twist. Of course, these techniques will be able to reduce the float of your cash collections. However, sometimes it entails cost. Like this lockbox system, sometimes, not sometimes, always, your bank will charge you for these services, lockbox system. So for example, your float is 6 days. But because your bank stated that you can have lockbox system, sir, in order to minimize your float. And then your collection daily is 100,000 per day. Okay? And then the company uh, wanted to charge you under the lockbox system services 80,000 per year. 80,000 per year. So there is cost involved. Okay? So lockbox system services cost 80,000 per year. You have 6 days float. You have 100,000 collections per day. And because of the lockbox system, this will not be eliminated 100%. There will be, for example, 4 days float. 3 days float. Okay. So reduce to 3 days. So you have saved time 3 days also. Okay? Now, aside from that, last given for the problem, uh, your investment earns 20% per annum. That's the whole example. The question is, will you push through the lockbox system? Again, your bank stated that you can reduce the float of your cash collections by 3 days. So, there will be a remaining float of 3 days only. However, the bad news is you have to pay for 80,000 per year. Okay? And that you have a daily collection of 100,000, and that if ever you can reduce the float by 3 days, whatever it is that you have saved, it will earn 20%. Okay? So you have to compute. How will you compute? Of course, you'll have to start with your daily collection. So your daily collection times reduction in float. So you will be happy. Reduction in float, which is 3 days. So 100,000 times 3, we have 300,000. Let's call this accelerated collections. These accelerated collections will earn the 20%. Okay? So 300,000 times 20%, that is 60,000. Okay? So that will be your income. Now, your cost is 80,000 per year using the lockbox system. Of course, 60,000 minus 80, you will have a negative 20,000 net cost. So the question is, will you pursue the lockbox system? Of course not. Because the cost is much more than the income that you are going to realize if the float is diminished. Okay? So that's the only twist here. Again, you have to minimize the float because, again, in the question, how fast your cash collections would you want to be? The answer is as fast as possible. Okay? So you have to minimize the float. Now, in minimizing the float again, sometimes it entails cost. So you have to compare the cost versus the investment income that you will earn because of the reduction of the float. Again, how do you get that income? You have to get the daily collection and then times the reduction or savings in float. We have 300,000 already here. Those are what we call as the accelerated collections. And from the accelerated collections, times 20% investment income, that will be your income because of the reduction in float. Okay? Now, let's talk about maximizing the float for payments. Now, how will you maximize the float in payments? Like for example, issue checks. Don't pay cash, issue checks. Because if you issue checks, there is a time where the recipient of the checks, they will not encash it immediately. So meaning, there will be a maximum float that will happen. Because the more days your issued checks are outstanding, you are maximizing the float. Okay? And sometimes, according to other books, you have to issue drafts instead of checks. What are these drafts? These drafts are like checks. However, when you pay those drafts to a certain person, creditor, supplier, whoever, that particular person will go to the bank for encashment, right? If that particular person will go to the bank will not yet encash the draft immediately. They will call you first, okay? They will confirm first if they have really paid. They will confirm, the bank will confirm from you if you have really paid a draft to a certain person or a certain party. Okay? So that is why some are using these drafts. And sometimes we have what do we call as 3 o'clock habit, where you issue checks during 3 o'clock so that the banks are already closed. So if the banks are already closed, then the person receiving such check will go back tomorrow. So you are maximizing the float. Okay? Then there is what do we call as 3 o'clock habit on Friday. Something like that. So meaning if you issue checks on a Friday and your bank only operates for 5 days. Okay? So meaning it does not operate Saturday and Sunday. So at 3 o'clock, the bank will close in Friday. So there is Saturday and Sunday to maximize your float. Okay? And the other one is that if in the collections, you are decentralizing your collections, you have agents, for example, collection agents in different places. In payments, you have to centralize your payments. So in the head office only. So meaning any collector, any creditor that you have will go first to a tiring process of payment with the head office. So that will also maximize the float. Okay? So every day of maximizing the float. Normally, the maximizing of float in payables does not entail cost because you just have to use drafts. There is no additional cost for this. And the 3 o'clock and the Friday, and stating that all the payments of the company should be in the central office, it does not really um, entail cost. Not like in the collections on the lockbox system that I have said. So, meaning, if ever you can delay, for example, let's use this, 100,000 per day. You can delay your payments for 1 day, then 100,000 times the float, delayed payment float, equals 100,000, and that 100,000 which is still in your account will earn the 20% of how much? 100,000 times 20%, that's 20,000. Imagine. What if your collections, daily collections is 10 million per day? Of course, you will earn a lot by just using the floats. Okay? So I guess that's it. The 5 questions. Actually, there are a lot of questions. The first one, how much cash will you leave the company? Of course, it's not zero, it's not large amount. Because if you have large cash balance in your company, you're not earning any return, right? The second question is, why is it not zero? Because of 3 things: transactional motive, speculative motive, and precautionary motive, right? And the third question will be how much cash, the optimum cash of conversion from the investments to your cash, so that you will meet your cash requirements. So that is answered by the Baumol model. And how much is the average cash, if ever? The average cash is the optimal cash converted from the investments to uh, the company's cash divided by 2 in order to get the average cash balance. Okay? And then how fast would you want your collections be? Then as fast as possible. So there are techniques in order to minimize the float, lockbox system, electronic payment, decentralizing collections, all of those. But sometimes it entails cost. So you have to compute the cost versus the additional income that you will earn because of the minimization of floats. Okay? And how slow your payments will be if you are deciding for the company, of course, as low as possible. So you have to maximize the floats. Okay? 3 o'clock habit. Thank God it's Friday. Something like that. And then centralizing the payment of the suppliers, using checks instead of cash, using drafts instead of checks. And that's it for this episode. So thank you for watching and see you on my next video.